So one of the really nice pieces of this legislation that came through is an increase in the exemption amount or the exclusion amount for an estate. They had tried with the legislation to completely remove the estate tax. They've been trying to remove it multiple times, went away for a short period of time, came back with a pretty decent size exemption. So we were at about the 5 million range index for inflation, so it had creeped up to 5.1 or 2, but now they've doubled it to 11.2 per person. So if you have and they still have portability. So the estate tax is basically kind of a balance sheet tax on what you have upon your death. When we raise that exemption amount to 11.2 or on a joint couple return where you can have portability, which is still out there, you can have a significant estate value before you're going to pay tax. So really it is truly the really large estates that will still be subject to tax, but they've really taken it off and made it easier for everybody else that you won't have to normally compute some of those. There won't be that tax. So most of us in this room were outside of this limitation and we don't have to worry about the estate tax. So that was a very significant part of the legislation that was very helpful for taxpayers. Some of the legislation items are permanent and some of them have a phase out. Most of the phase outs go through the end of 2025. So this provision will expire at the end of 2025. So it is a thought process now. Do you want to do, if you're in a significant, close to these exemption amounts, or you think it will come back down to the 5 million, depending on who's in office at a particular point in time, it might be a time to consider gifting and taking advantage of these large exemption amounts now. We have a little bit of time, hopefully. There won't be any talk of new legislation on this area for at least a couple years, but it is something to consider right now. Do you want to do gifting to take advantage of these and keep your estate below the minimum, below numbers that they may change in the future? They had talked when they brought this provision in about taking away the step up in basis. The step up in basis, you get the date of death value as your basis in inherited property. That is still in play. You still do get the step up in basis. They did not eliminate that with this legislation. That makes it so much easier to, sometimes we don't know what the actual cost basis was of the person who passed away. So to use that date of death value, and there's usually an advantage over the course of time that value has increased. So using the date of death value is a very important part of the legislation that we have. So that's still in play. The estate tax brackets for the income tax part of the estate and trust did change comparable to the individual changes. So after somebody passes, whatever income is earned by their estate then flows into a trust return. Or you could set up a trust before death. Those rate brackets are on your slide. And those you can see are comparable, that dropped to 37%. You can see that brackets for trust, you get to the top bracket almost right away. And we did see this on the slide for the kiddie tax when we saw that kiddie tax is now using those trust brackets. So you're almost in the 37% bracket fairly quickly when you're in a trust. The legislation, one of the primary reasons for the legislation that they talked about was to put us on an even playing field with all the corporations that were taking their money outside the country and reincorporating and moving their assets outside the country. The U.S., we have a worldwide taxing system. So we're normally taxing everything in the U.S. Our tax rates at the corporate level are higher than many other countries. So one of the drivers behind the legislation was trying to change the tax rate for corporations. One of the other drivers was tax simplification. So we've heard what Mike had to say. I don't know if you think it's simplified any of the tax laws, and after we go through my part of the presentation, I'd be interested to know if you think it has simplified anything. But we did see a change in the corporate tax rate. Instead of our bracket system for the corporations, it is now a flat rate of 21%. So easier to calculate, but sometimes beneficial to many corporations. Some of the smaller corporations, which were trying to use the lower brackets, the first 50,000 was at 15%, they're going to see an increase. But any corporation that was making over 100 and some thousand, it will be a decrease down to the 21%. There are some personal service corporations who were paying a flat tax rate of 35%, so it will be a decrease for those corporations as well for their total amount at 21%. Corporations did also have a dividends received deduction where they were able to exclude 80%, or it has now gone to 80% and 70%. I'm sorry, reduced to 65 and 50%, where you used to exclude 80% or 70%. The difference there was whether you own 20% or more of a corporation, then you can exclude the higher amount. They did repeal the corporate alternative minimum tax. We heard from Mike that the individual alternative minimum tax is still in play, but not likely to affect many people. The corporate AMT tax, we didn't see very much application of the corporate AMT, so the repeal of that doesn't have a significant effect, but it makes things easier because you don't have to do two calculations on a corporation anymore. They did change the loss carrybacks to eliminate carrybacks and put in play just carry forwards, took away the limitation on how many years you can carry forward, so it's unlimited now. And all of those changes are effective for tax years beginning after 2017. We may see, and we're going to talk about this on a different slide, some companies that will consider should they convert from an S to a C corporation. If you do that conversion, we want to talk to you obviously before you make that determination, because there are some challenges with some of your previously taxed income that we want to plan around. Now for one of the really big items and changes that came into place in this new legislation. And what we haven't seen, we've seen some write-ups. We've seen 1,000 pages, at least 1,000 pages, I think, of write-ups of what this new law is. But when we get into it, we're going to see that we need some regulations to be written by the IRS to do some interpretation of some of these provisions. The individual provisions, I think, are a little bit more clear-cut. If they tell us, okay, your state and real estate taxes are limited to $10,000, we can understand that. But some of the provisions I'm going to talk about, it might be more into the definition of what some of these provisions are that we're going to need some more assistance with. And I think as we go through this, you'll have questions in your mind. Is this me? Is this not me that this applies to? So the 20% deduction of is a 20% of qualified business income for a non-corporation. This was trying to get the equivalent tax rate that the corporations were at. We reduced the corporate rate to 21%, but a pass-through entity such as an S corporation or a C or a partnership is going to pay tax on the individual return. Individual return rates did get reduced at a maximum of 37%, but that's still higher than the 21% of the corporate rate that we saw. So they put in place something to try and bring that rate down by putting in a 20% business deduction on most corporations. And there's a lot of rules with this 20% business deduction. But if we take kind of a little chain of thought process and say, the first rule is if your income is $315,000 or less on a joint return, you will get the 20% business deduction against your business. If your income is higher than that on the pass-through entity that we're talking, or it could be a sole proprietorship that you had on your individual return, such that you had qualified business income from it. If your income is over that level, then we have to look to some other tests. One of the tests are you a specifically identified trade or business that they just said you cannot take it on those types of trade or businesses? An example of that would be like an accounting firm. We wouldn't be eligible. Law firms would not be eligible. I think you can see them all listed here. Actuary services, consulting, that's a hard one. Who is a consultant? How do you define consulting? What if your business produces something, but you also do consulting? Does that mean that you qualify? That's where we're missing the regulations here. That's where we're missing the interpretation. Do you look at the overall income of the company and what produces that income to say that the company qualifies and therefore you get the 20%? At this point, we're interpreting it to be that, but we need regulations that will tell us. And we'll probably see these as the year progresses. So as that comes out and is announced and we see those, we'll try and communicate that with you. If your principal service that you have to sell relates to the reputation of somebody or is some famous athlete, you do not qualify if you're over the income limits. So first, if you're under the income limits, you get the 20%. If you're over the limits, you look at, are you one of these types of trade or businesses that's producing the income? If you are, then you don't get it. If you pass the test and you say, okay, no, I manufacture, that's my primary business. Rental real estate can also qualify as a primary if it's run as a trade or business. If that's what your trade or business is, you pass this test, then you go to another test. And the other test is even more complicated, but it is the greater of two tests. One, what is 50% of your basically W-2 income on that business? So you could take either the 20% or you're limited to 50% of your trade or your 50% of your W-2 earnings. If you do not have any W-2 earnings, then that number will be 0 and you wouldn't be able to take the 20%. But there's another test. The other test is you can take the greater of that 50% of W-2 or 25% of your W-2s plus 2.5% of a tangible property test. The tangible property test is also another test we're probably going to need some regulations on. It's basically saying that you get it on what kind of property do you have in the business. And it's undepreciated property, so it's almost a separate calculation of depreciation. However, if you say you put a piece of equipment in that's $1 million, even though you take a quick expensing of that piece of equipment and you write it off, like we're going to talk later on bonus depreciation, and you write that all off, you still have a 10-year life on that piece of equipment for this test. So it's a different test than your standard depreciation, but it is a test on what do you have for property out there. So you can see how complicated this area is going to be when we try and run this calculation. But on a rental property, you might not have wages, so you're going to maybe get the deduction based on the second qualified property piece of the puzzle. After you calculate it on the business, this is claimed at the individual level. So after you calculate it on the business, you will have to net so that if you have one business that has a loss and one business that has income, you will net these two to determine if you have something when you're done that you take the 20% on. If you have a loss from a business, it could be a carryover for this calculation into the future against the future earnings of the company, because they don't want you to play games from year to year on whether you're trying to take a higher amount of the credit. But it is something to think about right now. If you're running a trade or business, perhaps you have a couple trades or businesses and your wages are in one entity, but maybe you do a management fee to the other entity, you may want to consider, should that entity have wages within it? Or will the fact that you have real or property investments in it allow you to take the 20% deduction? So a lot of moving pieces on how you get to that 20% deduction. But a significant deduction if you have significant income in the business. Certain things will qualify in that business income. There's a couple unusual areas, that dividends from a REIT, patronage dividends, and some qualified publicly traded partnerships will also qualify into the income. What won't qualify in the income? It's more your operating income it's going to exclude what you're earning if it's dividends, interest, and investment type items. It's more getting at what's your operating profit of the business. The next slide details a little bit more that I had discussed on the qualified property, that's tangible property subject to depreciation. It has to be available for use at the end of the year. So if you placed it in service or took it out of service during the year, it has to be in service at the end of the year to qualify for that particular test. This provision does sunset in 2025, similar to what I had talked about on the estate provision. So most payers, kind of a summary, as I discussed, will be able to take, normally you're going to have enough wages if you're running a business. That probably won't be a big limitation. So as long as you're not one of the qualified specified businesses that are excluded, you'll probably be able to take advantage of the business or the deduction. What does this do to your effective tax rate? Well, if you were in the top 37%, this is going to move that effective rate if you get a 20% deduction against it down to about 29.6. So you can see that it's still higher than the corporate rate of 21%, but has come down a significant deduction. What do you want to do with your C Corp versus S Corp? Because I just told you now that the S Corp rate is still at 29.6 if you take the deduction. We're getting a lot of questions on that, and that's a very good question to have. We do have an example in the material of an S Corp versus a C Corp. Actually, we have a couple examples. Our first example is a manufacturing example. And the reason that there's a difference here, in Wisconsin, if you're a manufacturer, you basically, with all the credits and deductions you're allowed, are not paying state income tax on your manufacturing income. You also do get a DPAD, domestic production activity deduction, as a manufacturer. So we'll come back to that example second. The first example, you're not getting those. You are paying state income tax. So as an S Corp, the top individual tax rate that's being passed through to you on a Wisconsin return would be at 7.65%. The top corporate Wisconsin tax rate is 7.9%. If we subtract those and then take off the federal taxes, you can see that the total taxes paid are $372,500. I'm sorry, let's stop at the remaining available for distribution is $627,500 under the S Corp and $727,590 under the C Corp. So you do pay more taxes, or you do have more available to you after you pay your taxes under the C Corp than the S Corp. But you have to get that money out to the shareholders at some point in time. You're either going to take it out as additional wages, you're going to take it out as a dividend, or you're going to liquidate the company. At some point in time, you're going to get it out of there unless you plan on leaving it to charity. If you left the stock to charity, I guess then you wouldn't have that. But otherwise, if you have any plans at all of liquidating the company, taking a dividend out of the company, or taking additional wages to get the money out of the company, eventually you're going to pay tax. That tax comes out at a dividend rate of, you could take it out as a dividend, you'd get the cheaper rates currently at 15 or 20% depending on your tax bracket. You're still going to pay additional tax. If you liquidate the company, you'll get a capital gains rate, you'll still pay more tax. So you can see when you add that additional tax, the double tax on of the C Corp, it is still cheaper to be an S corporation. The first one example we had was a non-manufacturer. If we run the same thing through for a manufacturer in our next example, if you have $390,000 of wages, $1 million in S Corp earnings, on the $1 million, there's a 9% domestic production activities deduction. That would equate to $90,000 of a deduction. You can see that your AGI under the prior law with the domestic production deduction was $1.3 million. Under the new law, that domestic production is gone, so that income is $1.390. If you look at your itemized deductions, and that has changed, you can see that under the new law, your allowable itemized deductions are $42,000. Your taxable income is $1,348,000. If we take 20% of that $1 million for your qualified business deduction, you would have a $200,000 deduction that would come off. And now your taxable income is less. Your taxes are less at the 37%. So you can see that there is now a savings under the new law of $81,000 in our particular example. I think I mentioned earlier that when we were talking about the qualified business deduction, that it is, the depreciation has been changing. They have played around with bonus depreciation from year to year. It was in place, it went away, it came back, it has a staggered period of time where it was going to be gone, but it's now back in place again. 100% bonus depreciation is available for anything that you want to place in service that qualifies. Bonus depreciation used to just be on new property. They've extended this so it can also cover used property. It has to be your first use of property, so you can't reacquire something that you had before and then take bonus depreciation on it. But otherwise, you have the ability to write off 100% of your acquisition cost. If you don't want bonus, you do have to elect out of the bonus. And so there might be reasons where you don't want bonus. You may be playing the game at one particular year. You want to maximize something with your 20% deduction and not claim the bonus on all of your property in one particular year. It is a class-by-class election, however, so if you have a particular class of property, it needs to be all or nothing on the class of property. They did also play around with some of the limitations on autos. They did increase the limitations that you can take, although they did limit, for some reason, they limited the amount that you can take of bonus depreciation. Regular depreciation, they increased some of the limits, as you can see in your material.
Jana, can I just quick comment, I guess? Or just make sure I'm thinking of it the same way, and just to mention to the folks, I mean, bottom line on the new depreciation and expensing, I mean, other than real estate, and even there's some exceptions there, and automobiles, I mean, it seems like you can write off or expense just about everything now, whether it be under the bonus rules or the Section 179, right? I mean,
yes, and they've
accurate.
Extended 179, except for the real estate that Mike mentioned. They also, though, did extend what you can take 179 on to include, let's just go to that slide first. Some of the things that traditionally were considered real property are the heating and cooling, the fire protection, alarm system, and roofs. So they've also extended that. So except for maybe the shell of the building or certain pieces of the building, that's about everything else is
can be written off immediately.
in one place or the other.
So, okay, yeah, thanks.
The bonus depreciation is subject to a phase-out chart. So in 2027, it will go away. But we may see new legislation because they seem to continually bring this one back up. They want to encourage us to reinvest into tangible personal property. When they adopted the legislation, they did try to balance out the numbers such that what they had in savings in one place, some increases balance some tax savings in other places. When they put in the bonus, kind of another feature, kind of the opposite side of things, was they took away something. One of the things that they did was put in place a limit on some interest deduction. So this is basically on a business, and there's an exception that I'll jump to right away, that if you're under 25 million of gross receipts, this limitation doesn't apply to you. But the limitation is 30% of your adjusted taxable income. So they want to, if you're going to put in $1 million piece of equipment and totally finance it, you get the deduction of the $1 million for the piece of equipment. You might lose out some of the interest on the financing depending on what your income is. You can carry forward if you're limited and you can't take the interest, it does become a carry forward, so it's not totally lost, but it might be lost in that calculation. But you might not need it if you've wiped out your income with your bonus depreciation. You might not need that financing in a particular year. The interest expense limitation, if it does apply to you, you have a couple of options too, depending if you're in the real estate area, because you will see a lot of financing in the real estate area. You can put an election in place not to take the total bonus depreciation, but to take a different depreciation method. And if you take that different depreciation method, then you don't have to worry about the interest limitation. If you have floor plan financing, and you'll see the floor plan financing is for a motor vehicle situation. If you have floor plan financing, those tend to be high gross receipts industries. If you think of a car dealer or a truck dealership where they might finance their fleet of vehicles, that floor plan financing for the cars that they may sell is offset with the interest, and that's allowable. You don't count that interest expense in the limitation. If you have a significant interest income, that will help you, and you do the test for the 30% of adjusted taxable income by adding in certain items. So you don't have to count the depreciation that you've taken before you figure out your 30%. So it may be a limited application to those that this particular provision applies to, and it can be planned around a little bit.
I would imagine, Jana, right? I mean, for most of our clients are seeing by the time, that second bullet point there where it computes adjusted taxable income, that's essentially an EBITDA calc, right? By the time you do that and apply your 30%, it's hard to envision too many situations with our client base that would be affected by it. There's always exceptions, right? But I think for the most part, hopefully they're not impacted negatively by it.
The next provision could affect some of our clients in a more significant way. Losses for taxpayers other than corporations are going to be limited to $500,000 on a joint return and $250,000 on an individual return. This is a netting process. So if you have one business entity that has $1 million loss and another that has a $600,000 profit, it will be netted together before you determine whether or not you are limited on your business loss. Amounts in excess of the limitation can be carried forward. Because we are losing some of our net operating loss carrybacks, this provision in some respects is not as large as you might, significant as it could have been, because you're really not increasing your net operating loss because you can't carry a loss back anyway. But it is another step in the process of what you're going to have to calculate on your individual return. This loss calculation is after we already had limitations on what we could do on passive losses, that we had limitations on being able to take the passive losses, but now we have a limitation on this situation where it could apply to active trades or businesses, and we hadn't seen that in place before. So you can only have so much room to offset your other income that you may have, such as investment income or W-2 income, by these business losses on your individual return. Your carry forwards of your net operating losses are also going to be limited, both on an individual level and a C Corp level, although the limitations are slightly different when you can take those net operating losses into the future.